Hello, everybody. No, the applause should not be for me. The presenters are the ones doing all the hard work. I think we're going to have to change the name of this series to Analytical Hall or Salon, because look at this crowd. This is great. So, next Analytical Corner is on corporate sector vulnerabilities in a high-rate world. Please welcome Anjun Rocha and Bruno Albuquerque.
Imagine you're a small business owner. You've spent years building your company, late nights, tight budgets, and taking out loans to expand your business. Business is going well. But suddenly, interest rates start going up considerably as central banks try to rein in inflation. Your loan payments go up sharply. Your refinancing options dry up. Your bank, once eager to lend, hesitates. Customers, feeling the squeeze themselves, start cutting back. What should you do? Should you cancel your expansion plans, lay off workers, or shut down?
Now imagine this is not just one business, but millions. Not just small enterprises, but also large corporations. Many businesses borrowed heavily when interest rates were low, expecting these cheap credit conditions to last. But now, with refinancing becoming a challenge, many businesses will struggle and fail. This is not a story of businesses struggling to adapt to changing market conditions. This is a story of corporate sector vulnerabilities that have the potential to become a systemic risk to financial stability.
Today, we ask two questions. What does a high-rate world mean for the corporate sector and for financial stability? And second, what can we do to make our economies more resilient? My name is Bruno Albuquerque, an economist in the Strategy, Policy and Review Department.
And I am Anjum Rocha, a lawyer in the legal department. During the COVID-19 pandemic, there was significant government support provided to corporates to keep them afloat. Now, with easing monetary conditions, you might imagine that corporate financial health has improved. Our research made a striking discovery. Corporate vulnerabilities appear to be growing. Corporate vulnerabilities can take many forms. Today, we focus on three. The rise of so-called zombie firms. Zombie firms are firms that are unproductive and trap capital and investment for a long period of time. The second vulnerability that we will consider today is the higher refinancing costs. And the third, a wave of corporate defaults that could potentially destabilize the financial sector. Ready? Let's dive in. So, talking about the growth of zombie firms, in 2023, we found that 10% of listed firms were zombies. This is twice the number in 2000. You might ask me, why does that matter? It matters for two reasons. First, because zombie firms result in a misallocation of capital and credit, taking resources away from productive firms, and stifling investment and growth. Second, they weigh heavily on the balance sheet of banks, creating hidden risks to vulnerability. This is the reason why we care about zombie firms.
The second key vulnerability is the looming corporate refinancing needs that you see in this figure. The bubble size represents some amount of outstanding corporate debt in each one of the currencies. A bubble above the horizontal axis means that debt is refinanced at higher rates compared to what firms pay on existing debt. The difference between 26 and before the pandemic is stark. Debt maturing in 2026, red circles, will be refinanced at much higher rates compared to what firms paid when they had to roll over debt in 2019, given by the yellow circles. Several firms will struggle with these higher refinancing costs, especially in countries with floating rate debt, further straining firms' debt repayment capacity. We provide evidence in this figure that firms with high debt rollover needs are affected the most by high interest rates. When interest rates increase, these firms experience sharper declines in investment, in debt, and alongside a sharper increase in financing costs. Our estimates show that these effects are quite persistent, lasting for at least 12 quarters. Overall, the decline in financial performance of these firms with high debt rollover needs can potentially amplify economic downturns. This brings us to the final key vulnerability. What are the implications to the financial system if several struggling businesses were to default? To find out, we stress test the financial system. We build a scenario where weaker demand and higher interest rates spread to the corporate sector, leading to a wave of defaults. The results, eye-opening. We find that capital buffers, we show here the bank capital, the impact on bank capital for both advanced economies and emerging markets up to 3 years ahead, if this scenario were to materialize. We find that bank capital buffers can take a serious hit, the buffers that many banks accumulated during the pandemic. Especially in emerging markets, you can see the orange bars. Emerging markets, bank capital in emerging markets could fall by almost 35% after 3 years if this scenario were to materialize. We find a strong effect because these economies in emerging markets typically rely more on loans than on bonds, and loans in these countries are associated with higher default rates. While hypothetical, our simulations stress that corporate vulnerabilities can destabilize the whole financial system, as we have seen in the past. To add to this complexity of corporate vulnerabilities, there is a recent phenomenon that we show in this figure, the growing role of non-bank financial institutions in corporate lending. These non-banks, which include investment banks, pension funds, insurance companies, asset managers, among others, accounted for roughly 40% of the global corporate syndicated loan market in 2022, and this share has been rising ever since. This matters because non-banks are fundamentally different from banks along some dimensions. They typically tend to take on riskier loans, including to zombie firms and low productivity companies. They also tend to rely more on volatile sources of funding, and they also operate in a more regulatory gray area with significant data gaps. As we see credit shifting from the banking sector to the less regulated sector of the economy, a wave of defaults could spread more unpredictably through the financial system. Closing data gaps, extending the regulatory perimeter to these non-banks can enhance the resilience of our economies to future shocks, including from the corporate sector.
As a lawyer, allow me to share a legal perspective. In countries with rising levels of corporate debt distress, the legal system can play a significant role in helping resolve that distress. So let's think back to our example of the small business that is struggling. The creditors of this small business will need to decide whether the business has more value as a going concern or whether it should be liquidated to maximize value for creditors. The legal system has to facilitate both outcomes, the effective rescue of viable firms, as well as the speedy liquidation of unviable firms. In countries where these systems are weak and these modalities are weak, we see that the time taken to resolve debt distress is high, the cost of resolving debt distress is high, and the yield to creditors is unfortunately extremely low. So to assess where countries stood on managing corporate debt distress, we in 2022 created a crisis prevention indicator. The crisis prevention indicator that you see on your screen here has 5 prongs or pillars. In the blue boxes, you will see references to liquidation and reorganization, which are typically procedures found in insolvency laws and are formal procedures that are available to companies. Hybrid restructuring and out-of-court restructuring that you see in the orange boxes are included in our indicator. Why? Because although these processes are less formal and they take place with limited court involvement and supervision, they are critical because they can reduce the burden on courts and allow the courts and the judiciary to focus on the most complex and most critical cases. The indicator also includes institutions. Institutions are really important. They are instrumental in ensuring that there is predictability and certainty in outcomes, which can help build confidence in the insolvency system. So that, my friends, is our indicator. What now?
So we started today with a simple but powerful question. What happens when several businesses struggle to refinance in a world of high interest rates? We have seen how firms with high debt rollover needs face real risks, how zombie firms continue to drain resources from the economy, how a wave of defaults could destabilize the financial system, and how the growing role of non-banks introduces new vulnerabilities, ones that we don't fully understand yet.
But yet, the key takeaway is not doom and gloom. While these risks exist, there are also tools to mitigate these risks. Smart policy choices, such as closing data gaps, regulatory gaps, strengthening insolvency systems, and better supervision and oversight can help turn these vulnerabilities into resilience. Thank you very much.
Okay, we're ready for questions. We'll take one at a time this time. So who wants to start? Yes, please. Gentleman in the front.
Should we blame the monetary authorities for rising debts? Because, for instance, in the UK, following COVID, interest rate was below 1%. That's the Bank of England base rate. And post-COVID, the massive spending drove up prices. Russian war in Ukraine, combined increase in energy prices and inflation went up. And conventionally, to combat that inflation, the Bank of England started raising interest rate from less than 1% to over 5%. And that is driving other interest rate because that's the base rate. Should we then blame the monetary authorities for creating the platform that generate these unintended outcomes? Thank you.
So the way I would start is, so monetary policy, I would say, all over the world, during the early stages of the pandemic, in the middle and after, they were focused on their mandate. Of course, take into account the impact on financial stability. But for financial stability, there are other tools that we also discussed in the paper here. If you scan the QR code, it's a long paper and that we published in January, but we have plenty of information there. We stressed some of the vulnerabilities that existed before the pandemic. For instance, the number of zombie firms, right? And while public stimulus, including monetary policy, was important to contain the massive shock to avoid the GFC style type of shock, and I would say it was effective in containing that collapse in aggregate demand, but it might have some unintended effects that you hinted at. The reason why we stress in the paper that while monetary policies focus on their mandate to get inflation on target, there are other tools that we stress that has served the countries really well, and we stress insolvency frameworks. For instance, zombie firms. If these firms are unviable and unproductive, in a way we should develop mechanisms that can resolve these distressed firms quickly at a low cost to allow other more efficient firms to step in. So there are other tools, including solvency frameworks. On macro-pro, we didn't mention here much, but in the paper we discussed that financial regulation is very important to strengthen banks' capital and to better assess the underlying risks from corporate sector.
Very good. Next question. This lady in the center. You can identify yourself if you want. There's no problem in that.
Hi, I'm Mukta Malhotra. I'm part of the World Bank. So it would be interesting to know a policy intervention which has worked earlier, especially in the emerging economies where such kind of crisis was coming, but that policy intervention or institutional strengthening kind of helped in some way managing it or delaying it or actually maybe diverting it.
I think it's hard to talk about the crisis that didn't happen, right? The crisis that did is easier to talk about because we've all felt it. And the crises that have been averted are the ones that we don't even know about. So I think that here, what we are going for is encouraging policymakers to think about crisis preparedness, not crisis management. Because as we know, it's much better to prevent somebody from getting sick than to treat them when they are sick. So that's the main message of this paper. Thank you.
Please.
Hi, my name is Bahaki Burhane. I'm with the GOPA. We're a German-based consulting firm. So my question is, on blended finance, obviously catalyzing, the use of grant, debt, technical assistance, to catalyze and mobilize more private sector funding, right? So one of the uses is basically to reduce the cost of capital for the likes of SMEs, MSMEs, and others that, they just don't have that access to capital or easy access to capital in general, right? So when you mention, obviously there's a vulnerability, high interest rate, and all of that, how does that impact the world of blended finance, I guess, in your research? Obviously, there's Convergence has a report of 15 years report where development official ODA has significantly decreased due to the war in Ukraine towards the blended finance, catalyzing, mobilizing private sector to play a part in this. So just wanted to see, your research on this topic. Thank you.
So I hope I'm not wrong, but the answer to your question will most likely be given tomorrow at 2 p.m., if I'm not wrong. There is an Analytical Corner exactly on that. So our colleague Joe Rogan from MCM, he actually develops that narrative. So I would not say anything else from here.
Okay, who's next? Yes, please. First row.
Hello, my name is Marina. I'm a PhD student from Princeton University. The topic is high interest rates, although we might want to say the high interest rate growth rate, which happened over 2 years. And now it's coming back to pre-financial crisis standards. I think what I would be interested in to ask is more about the other banks that they lend to these corporations, and whether there is a way to stabilize or regulate how they offer credit, because it could be in much higher rates than accessing other banks.
So sorry, your question on, are you focusing also on non-banks?
Yes,
lending?
The rise of more than 40% of other banks, such as investment banking.
Yeah. So this is something that we also discuss in the paper, which you might get an impression here that we are painting non-banks in a very, dark way. So non-banks, we discuss it in the paper. Non-banks play an important role in allocating funding to productive uses that otherwise the traditional banking system would not. So non-banks, they take on more risk. And that in itself is not necessarily bad. What we stress is, in the paper, is that there are significant data gaps. So for the regulator to assess better the underlying risks, the corporate credit risks, there are significant data gaps on the balance sheets of the non-banks, on leverage, on liquidity mismatches. So this is the reason why we signal that this is a concern, because we know less. And also, but it's less regulated sector. It's not, in the US, for instance, investment banks, they are regulated, but they are less regulated than the traditional commercial banks. And we also discuss in the paper that there is, we haven't discussed it here, but the rise of private credit, which is typically sourced by non-banks. And this typically comes at a high interest rates. It's direct, it's immediate, it's not necessarily big loans, but if you sum them up, they can be quite big loans. And traditionally, they go to unrated firms and also firms at high risk of default. So while this can play an important role for the world economy because it goes potentially to productive uses, but we know less. And it's over-the-counter markets typically, and so we stress a lot on increasing the regulatory environment on that front so that we can minimize this bank, non-bank financial nexus. Thank you.
Time for a couple more questions. Yes, sir.
Rodrigo Valderrama, Embassy Row Invest. So the implication here is that you should really regulate some of the private sector and the non-formal sector, but doesn't that also imply a moral hazard for the government because it would, by implication, by regulating them, vouch for their operations and then have to cover some of the private sector informal debt? And that would increase the debt, which we had the previous session on. So your thoughts on that, please.
Yeah, I'm thinking about it. I cannot use another analytical corner to direct the answer. So let me give you the example on zombie firms, which I've studied quite a bit. One of the issues of the emergence of the zombie firms that dates back to Japan last decade, 80s, 90s, was that banks had low capital and regulation was relatively weak, which created incentives for banks to take on more risks, to window dress their balance sheets. And so the weak regulation might have not necessarily created but amplified this problem. At the end of the day, then the sovereign might need to step in, which we want to avoid. And so if we don't regulate non-banks at all, if there is a crisis, whether it's banking, financial, economic crisis, there is the possibility that if there are very large firms, corporate firms, the sovereign would need to step in and bail out these unproductive, unviable firms. So the fact that we can extend the regulatory perimeter to non-banks, which of course it might always have costs for the financial sector, but at least we know better the underlying risk in that sector and minimize the intervention, the possible or potential intervention of the public sector, which at the end of the day will cost taxpayers money.
And if I may add, the goal is to set up facilitative infrastructure that allows the market to allocate risks and costs rather than for the state to assume the costs as being fiscal costs. So that's the whole purpose of this exercise, to mitigate that solo burden sharing.
Thank you. One final question. I think the gentleman there had his hand up.
I'm Henry Schiffman. I'm a consultant on financial sector reform. In developing countries, in formal insolvency proceedings, often the courts are not really equipped to accomplish these proceedings efficiently. So I wonder whether contractual arrangements have been considered. For example, if a major lender has as part of the loan agreement that if there's a default by the borrower with some grace period, then the lender has the right to sell the company or the company's assets. And it could be a contractual arrangement that if there are other creditors, they would be paid in the order that they would be paid if there had been a formal proceeding. So in other words, get away from the courts and try to find arrangements contractually.
Thank you. Contractual arrangements have been tried in various countries before. I can think of Turkey, and during the Asian crisis, there were modalities that allowed for banks to enter into these umbrella framework agreements ahead of time. However, they always come with limitations because they only bind those that are participants in the contractual agreement. They would not bind, for example, operational creditors, tax creditors, and others that fall outside the scope of that agreement. The second point that I'd like to make is that while it can serve as a temporary substitute, the real work that countries with weak institutions need to do is to shore up those institutions and strengthen them, to build their judicial capacity, to have specialized judiciaries and courts that can help apply the legal framework effectively. So yes, while contractual solutions are an option, they have their limitations and they have been tested in the past. And we think that the better solution in the longer term is to shore up the institutions themselves. Thank you.
Thank you very much. We come to the conclusion of this analytical corner. Bruno, Anjuman, any final thoughts?
Yes. So today we have seen that corporate vulnerabilities can take many forms. And we discussed 3. There are many more in the paper. And that they can affect the real economy and the financial system. History also shows that economies don't crumble just because risks exist. So economies struggle when those risks go unaddressed. We have made the case today, including in the Q&A, for smarter policy choices, which includes strengthening insolvency frameworks, stronger policy oversight, closing regulatory gaps. We believe these policies can make our economies more resilient. Thank you.
Thank you, Bruno. Thank you all for coming. And let me invite you to be back tomorrow at 2 o'clock when the analytical corner that Bruno mentioned on the role of IMF programs in restoring market access is going to be presented, and at 2:30 on the rise of the silver economy. Thank you very much and have a good day.
Thank you.
Thank you.